Hi everyone. This presentation is made by Gap Advisors with voice recording by me, CA Priyanka Wazirani, Resource Person Gap Advisors. In this video, we are going to discuss accounting for insurance claims under Ind AS by analyzing an accounting policy published in a listed company's financial statements and its appropriateness under Ind AS framework. Friends, on your screens, you can see the sample accounting policy on income from insurance claims from published financial statements of a listed company. The policy states that where amount of claim receivable cannot be ascertained with reasonable certainty, it is recognized only when the collection is virtually certain, which generally coincides with receipt and is netted off from related expenses. Well, you would have noticed that the policy has two aspects to it. One, timing of recognition, and two, presentation. The timing of recognition is based on whether the claim can be measured with reasonable certainty. Where insurance claims can be measured with reasonable certainty, the company recognizes the receivable and income from insurance claim both. However, where the claims cannot be measured with reasonable certainty, the recognition is postponed till the receipt of the claim becomes virtually certain. We'll understand whether such postponement till virtual certainty is appropriate. Insofar as the presentation is concerned, the company offsets insurance claim income and the loss of asset in profit or loss. That is, it presents them on net basis. We'll understand whether such a presentation on net basis is appropriate. Loss of an item of an asset on occurrence of an insured event is impairment of asset, and the insurance claim that becomes receivable is compensation for the impairment. Therefore, paragraph 65 of Ind AS 16 is the paragraph that needs to be applied for loss of plant due to fire or any other insured event, in accordance with the requirement of paragraph 7 of Ind AS 8, which deals with accounting policies, changes in accounting estimates, and errors. Now, paragraph 65 of Ind AS 16 states that compensation from third parties for items of property, plant, and equipment that were impaired, lost, or given up shall be included in profit or loss when the compensation becomes receivable. Paragraph 66 of Ind AS 16 explains the principle enunciated in paragraph 65. Let's read through the requirements of paragraph 66. It says, impairments or losses of items of property, plant, and equipment, related claims for, or payments of compensation from third parties, and any subsequent purchase or construction of replacement assets are separate economic events. Now, firstly, loss of an item of property, plant, and equipment and income from insurance claims are separate economic events. This itself indicates that loss must not be offset with income from insurance claims. Now let's see how these separate economic events are accounted for separately. Point number A says, impairments of items of property, plant, and equipment are recognized in accordance with Ind AS 36. Ind AS 36 requires impairment loss to be recognized when the carrying amount is higher than recoverable amount. Recoverable amount is higher of value in use and fair value less costs of disposal. For an asset that is no more in existence or not under the control of the company, the recoverable amount is zero, and therefore the entire carrying amount of the asset is loss on impairment. Point number B says, derecognition of items of property, plant, and equipment retired or disposed of is determined in accordance with this standard. What does the standard say for derecognition? It says the carrying amount of an item of property, plant, and equipment shall be derecognized on disposal or when no future economic benefits are expected from its use or disposal. Point number C says compensation from third parties for items of property, plant, and equipment that were impaired, lost, or given up is included in determining profit or loss when it becomes receivable. Friends, though the standard provides guidance to recognize receivable from insurance claim when it becomes receivable, it does not provide any guidance on the point in time when a company can say that the claim has become receivable and therefore needs to be recognized at that point in time. Point number D says the cost of items of property, plant and equipment restored, purchased or constructed as replacements is determined in accordance with this standard. Okay, so what we understand from this overall guidance is that the company must recognize loss and de-recognize the item of property, plant and equipment on occurrence of the insured event. The company must not postpone the recognition of such loss till the time the income from insurance claim is recognized. Further, the company must recognize the income from insurance claim when the same becomes receivable. Thus, the company cannot offset insurance claim income and the loss of asset. Both need to be presented separately. It could happen that in one year loss is recognized and in another year income is recognized. Because of lack of guidance on the point in time the insurance claim becomes receivable, the company applies paragraphs 10 to 12 of Ind AS 8 to decide on the appropriate accounting policy. Considering the requirements of paragraph 11, the company will have to look into other standards under the Ind AS framework that provide guidance on recognition of income. The company looks at Ind AS 20, which deals with recognition of grant income, Ind AS 115, which deals with recognition and measurement of revenues, and the conceptual framework for financial reporting under Ind AS issued by the Institute of Chartered Accountants of India. The guidance on recognition of lease income in Ind AS 116 is not relevant to the given case and therefore not considered. Ind AS 20 lays down these requirements for grant income recognition. This standard requires recognition when there is a reasonable assurance that all the conditions are met and that the amount will be received. There is no requirement on virtual certainty basis. Ind AS 115 also requires recognition when the performance obligation is satisfied. Further, it also provides guidance on measurement. In case of variable consideration, Ind AS 115 requires the company to estimate the transaction price and thus the revenue based on expected value method and most likely method. However, the amount estimated must not result in significant reversal when the uncertainty is resolved. Guys, Appendix C of Ind AS 12 on uncertainty over income tax treatments also requires the same methods to be applied. Therefore, neither Ind AS 115 nor Appendix C of Ind AS 12 require postponement till the virtual certainty exists. Now coming to the conceptual framework, it provides guidance on recognition of asset or liability where the probability of an inflow or outflow is low. Therefore, where the inflow from insurance claim cannot be ascertained with reasonable certainty, the company also considers the guidance provided in the conceptual framework. Conceptual framework differentiates the transaction into either exchange transaction or non-exchange transaction. Exchange transaction is one where consideration is flowing from each of the parties to the transaction. A non-exchange transaction is where the consideration is flowing only from one of the parties. For example, insurance is an exchange transaction, whereas government grant is a non-exchange transaction. Therefore, in a strict sense, the company cannot apply the requirements of Ind AS 20 for recognizing receivable from insurance claim. Therefore, the company cannot postpone the recognition of claim till the receipt becomes virtually certain. The company must estimate the amount of the claim based on expected value method and recognize the receivable. Further, the company must disclose the uncertainties that may affect the estimate and provide sensitivity analysis in accordance with paragraph 125 and 112C of Ind AS 1, which deals with the presentation of financial statements. In our conclusion, let's first talk about the timing of recognition. The insurance claim receivable should be recognized when it becomes receivable. That is, when the company has fulfilled all the conditions as per the insurance contract. The postponement of recognition of claim income till the receipt of the claim becomes virtually certain is not appropriate. Coming to measurement, the insurance claim receivable should be measured on expected value method as explained in Ind AS 115. The basis of estimate and the uncertainties that may affect the estimate should be disclosed with sensitivity analysis as required by paragraphs 112C and 125 of Ind AS 1. Therefore, the accounting policy which states about the recognition on virtual certainty when the claim income is not reasonably certain is not proper. Further, impairment loss and income from insurance claim need to be recognized on gross basis, thus presenting on net basis, that is, offsetting income from insurance claim and loss on impairment of asset is not proper. Lastly, please note that by virtue of the requirements of paragraphs 10 and 11 of Ind AS 8, which we have discussed in the earlier slides, the same process applies to insurance claims on inventory or investment properties or any other asset that is not a financial asset. Guys, hope you liked the video. Thank you.